You want to be managing risk first and then making profit later. So guys, so since we're coming to the end of February and we're all caught up on trades and stuff like that, about risk management, which is one of the most important things about trading in general and trading in the financial markets. You want to protect your capital at all times. Protect your capital comes first before making profit. Managing risk always comes first before making profit. This is how you stay alive long term in the markets. Trust me, you need to understand to always position yourself in a place where you're going to make profit, even if you take 1, 2, 3, 4 losses. I mean, there may be scenarios, especially in your early stages, where you might find yourself taking a lot of losses, but it's really just protect yourself, because even if you're not making any money, you really don't want to lose tons of money. You've got to look at your account in a percentage way, and give yourself as much room as for error as possible, especially in the beginning phase, because you're going to take a lot of stress is going to come from losing. You want to get used to losing as well, because that is a skill in itself. So percentage risk, they say like low percentages. To be honest, the percentage risk doesn't really matter. It's all up to you if what percentage you want to risk. But just looking at your account in that way, as if it's like you lose 2%, then you've only got 98% left, you know. Like if you look at it in that way, and like how many losses you can take before it's completely blown, then you're well on the way to managing risk, right? I advise people to focus on risk to reward more, but a lot of people tend to be more interested in win rate. Now, I'm going to say that if you focus on risk to reward, win rate does not matter at all. Realistically, you can have like a 40% win rate, and you could have like an insane risk to reward if you've like positioned yourself well for runners and stuff like that. And I find that you're going to find yourself in much bigger trades that way as well, because you have much more of an opportunity to catch those bigger trades. Yeah, especially now, like at the beginning it was a little bit lower, and I feel like I was still making money, but I was just making far less, obviously, because my win rate was a little bit low. You can still get it, like if your win rate's like 40% and you've got like a pretty high risk to reward, then you can easily get that 40% win rate to like 50, 60, 70, you know. Like you might have to sacrifice a little bit of risk to reward to get that 80. So risk to reward is a huge part of risk management, for me at least, because the way I go off it is that all my profit is like the risk to reward is just times my risk, right? So if I'm risking 1%, for example, my winners need to be 3%, and they will always be 3%. Otherwise, it won't be a winner; it will be a loss. Or it'll be a break even, depending on what price action does. That's how I structure my trades. So when I lose a trade, it's just the same percentage or the same money amount, depending on the account that I'm trading. That will basically equal 1 risk to reward. So if I'm up 9 risk to reward, for instance, for a week, right, I've won 3 trades in a row, I'm up 3R times 3. If I take a loss there, I'm just down to 8R at that point. I'm still well above, even after a loss. I could take even 3 losses, I'm up 5, 6R. That's how I position myself to remain profitable, even when taking a string of losses, or taking a lot of losses in a month or a week or a year. Like that's how I deal with it, and keep my losses the same. The key part about risk management is your losses have to be the same, whether that's like $100 out of $1,000 if you want to risk that, or a percentage out of your overall capital that you want to comfortably risk. Because if you're risking 1%, for instance, you've got 100 losses before you blow the entire account. If you're trading on a personal account with personal full capital, say you have $1,000, you risk a 1% of that, which is $10. You're gonna, well, there's NY Open, boys. That's what that fucking alarm was. But anyway, if you're risking 1%, you get 100 losses before that thing is completely blown, 100%, right? And it halves when you go to 2%. Obviously, it's 50. With a smaller account, I might not even pay attention to the percentage at all. I'll just use a dollar amount that I'm comfortable with risking on that account, that I feel like I can I feel comfortable trading with, and with my experience I can very easily gauge that depending on whatever size account it is. I'm comfortable with, I'll lock in that risk, and then it'll just be 3 times whatever that. So if it's like $50, it'll be $150 win. So if I'm comfortable risking $50 of 1,000, which in some cases I might be, my wins are going to be 150, and that's how I would approach it. But if I was dealing with a larger capital, I would just use percentages like between 0.5% and 1%. If I would say like 1% normal risk, and then 0.5% like a little bit like managed risk, half risk, that's what I would say. If I'm looking at like bigger capital, I'm talking about like 50k upwards. So like anything like sub 10k, I'm like using a dollar amount that I'm psychologically comfortable with, which that might be totally different to you depending on your circumstances. So if you want to approach that like with the dollar amount, I just don't really see the point in risking a percentage amount with small capital, especially in my position in life. It doesn't make sense. So yeah, I would just use dollar amounts with sub 10k, or let's sub 5k, let's say. It depends, because if it's a challenge account, then I'd use a totally different approach. I would use percentages, but in a different way. That's how I would approach it. Obviously with higher capital accounts, I can use percentages, and I would use, like I said, between 0.5% to 1%. So my wins would be roughly between 1.5% to 3% if I'm risking 0.5% to 1% on per trade. So say I take 4 trades, lose 2, win 2 in a week, and I'm up 4R for the end of the week. Still, so 4 times my risk. So if my risk is like $100 for that week, $400 at the end of the week. Yeah. Initially making $600, but then taking those 2 losses that were each $100, and that's how it works. Proper risk management structure. But it's very important that you stick to a set loss limit, basically, so you can manage trades live and make sure that you lose less than you actually anticipated. But obviously you don't want to be losing anything over that limit that you've set yourself, whatever that limit is. And that's how the math works out, because if you start losing more, then it's going to eat into your risk to reward, and you're not going to get the risk to reward results that you want or desire, because your losses are going to eat into it if they're bigger than they should be. Now if they're smaller, then obviously that equals more profit on top, so that's a great thing. But if you set a limit, that's part of your plan, and you stick to that limit. If you hit that limit in a day, you don't take another trade, because then it'll be like taking 2 days of losses basically in one day, which is not good. That's basically just a quick rundown of how you manage risk. But yeah, it's your premise of risk management is based around risk to reward and percentage risk based on dollar amounts. I'm going to use a percentage risk on $100. That's completely up to you. I feel as though that's a waste of time. I wouldn't even use 1% risk on $1,000, I don't think, because it just simply is just not enough. I want my wins to be bigger than that if it's $1,000. But I mean, it's a good way to start. If you're a beginner, if you have $1,000 to invest, you start with 1% risk. That isn't a bad thing to do. I think you should do that. I advise everyone to be religious to your risk management plan, right? Set a dollar amount risk, percentage amount risk, stick to that for your account. 3 losses, 4 losses, maybe at a push 5 losses if it's really bad, but you really shouldn't be taking that many in a row. But if you take 4, you after 2 wins of 1 to 3, let's say, just if you're copying what I do, like you do a 1 to 3, like minimum 1 to 3, 2 wins essentially covers 4 losses, even 5 losses if you want to throw that in, and it's still profitable. So you could take 4 losses in a row, 2 wins clears that, and you're back into profit. You understand? That's the power of risk to reward. And obviously you're having a really bad time if you're taking 4 losses. Like say you take 1 trade a day, right, and you take 4 losses across 4 days, you're having a really bad month. I'm just going to say it to you. You have all these tools now to work out risk for you, so you don't even have to do it manually in your head, work it out, percentage stuff. Even there's calculators for that now, like Magic Keys. There's ways that you can help yourself manage risk in a professional way, because that's what this shit is about. You need to be managing risk in a professional way. Like I said at the start of the video, you want to be managing risk first and then making profit later. I want to have the idea of, like, when you get into a trade, you have this amount risked and you're not going to risk anymore, and you're going to aim to risk, you're going to aim to actually lose less than that if you possibly can. Like, that's what your main focus should be. Just let the trade run to target if it's going to, or it's giving you bad confirmations against your trade. You're going to be there to mitigate risk. You're going to be there to manage risk and professionally manage the trade and make sure that you can, well, if there's an opportunity to lose less money, you should be there to take advantage of it, basically what I'm saying. You have no control over whether your target is actually going to get hit or not. That's completely up to the market. Once you're in the trade, there's zero control over that. The only thing you have control over is how much you are going to lose if it doesn't work out. That is the only thing.